Welcome to Echo Trade. This is Jeff Roth, and we are here again with Eben Burr, president of Toews Asset Management, coming to us from New York. And Eben, thanks for being here. Eben just had a big week last week. They rang the bell at the New York Stock Exchange, so that must have been pretty exciting. Tell us about that.
Thanks for having me, Jeff. It was totally thrilling. On a personal level, just amazing to be up there on the podium, looking down on the exchange floor where so much history has been made. And then from a perspective of Toews as a business, it's a tremendous milestone that really, was hard to absorb the gravity of being there. I'm completely humbled by the experience.
Yeah, no, it's awesome. I mean, it's a massive, accomplishment, a huge honor. So we're excited for you guys and an awesome experience. So
Yeah,
but today we're here to talk
about. One thing I learned, more people watch that than the Super Bowl.
I know, that's crazy because it's kind of more of a global kind of a thing.
Yeah.
Yeah, that's crazy. So you are a global superstar now, Eben.
Basically a quarterback. Yeah.
Pretty much. But today we're here to talk about, the Toews tactical high income bond model on Echo Trade. And so excited to talk about this specifically because, I think most of the portfolios on Echo Trade are purely kind of, equity focused. But I think this is the only one that's exclusively focused on the fixed income side, getting access through ETFs, but a pure, fixed income bond model. So excited to talk about it, excited to have it on the platform. So if you could kind of, just to start, what's the specific kind of monetary goal of the portfolio?
Sure. We think that it's a really cool platform that you're running here, and we're really excited to be on it. When we allocate our model, and as we've been doing as a firm for 26 years in fixed income, we're looking at yield, stability, growth, and risk management. And so the portfolio is designed for those who are looking for sort of a ballast in their portfolio allocation. Mm-hmm. So yield, obviously, it's fixed income. That's what you're looking for, a sort of consistent payment, if you will. Mm-hmm. And then stability, well, it's usually runs countercyclical to equities, or it's a diversifier for equities. Yep. Growth, modest growth, we expect that from fixed income, and then risk management. So when equities get hit, we hope that fixed income doesn't. Now, basically all of those things got turned upside down in the last, in 2022.
Yeah.
So yield, which was essentially nothing for decades practically.
With such a low interest rate environment. Yeah.
Yeah. Such a low interest rate environment that it was kind of nothing. And you just sort of put money in there when all right, well, it'll be all right. It'll be there.
Yeah.
But stability also got, crushed last year because equities, if you look at aggregate bond, which is sort of a basket of a bunch of different kinds of bonds, was down, I think 16 or 18% at the worst of it last year, got completely killed. And then growth, obviously down, not what we expect of bonds. Risk management, nope. So all of these things that bonds are known for just didn't work last year.
Yeah.
And they were correlated with equities. They went down with equities, which is what, non-correlation with equities is sort of one of the selling points of bonds. Yeah. However, when you look back at the history of bonds, we, as probably most of the people who might be watching this, have really only experienced a bull market in bonds. Since the early 80s, interest rates have been going down, which means bond prices go up, which means we do well with bonds. But prior to that, there was a 36-year bear market in fixed income. When you look at real returns, they were down 21% during that time. And that doesn't even take into consideration the cost of ownership, right?
Yeah.
So these kinds of markets do happen, and they last a very long time, or they can last a very long time. So we think that having a fixed income strategy that is nimble, that can shift between high yield bonds, between aggregate bonds, between treasuries, between cash, depending on where the opportunity is absolutely essential at all times, but especially right now where we have rising interest rates and inflation is higher than it's been in a very long time.
Yeah. So, I mean, you're talking a little bit to the tactical side of the portfolio, right? So where historically, fixed income models are not going to be necessarily as tactical as yours. So can you kind of give a little bit of history on that, you're a little bit of an outlier in terms of other fixed income models in your approach and that tactical approach, correct?
Yeah. We started trading fixed income tactically in 1996, which at the time was, people just thought that was kind of bananas to do that. It was like, well, you just buy a bond and you hold it and then you get paid back at the end. And that's what a
Yeah.
bond is.
Mm-hmm.
But all opportunities are not created equal. So we are looking to get a higher yield over a full market cycle. Any instrument that you use that is not a single ticker, I guess, basically, you need to use it over a full market cycle to get the full scope of what it's capable of doing. So we're going to be investing in higher yields. Now, that being said, we also have the ability to go all the way to cash, just to exit the market entirely, which we did last year.
Yeah.
And then it's a matter of managing the cash. What can you do with that cash that is ultra safe, but maybe getting a higher yield than, real cash, which is nothing, right? So the idea of any fixed income portfolio is to bring stability overall. And now that we have decidedly entered this period of higher rates, and inflation, though it's coming down, is still higher than it's been in a while prior to 2022. What is going to work in a portfolio to create stability, yield, growth, and risk management? And it's got to be something that can shift and look for opportunities. But what you don't want to get stuck doing is trying to predict the future.
Yeah.
That is a great way to lose money because it's very hard. And when we're making a prediction, usually it's based on something that we are either excited or afraid of. So all of our trading is done based on mathematical formulas that we've developed over the decades and through multiple decades of research before that.
Yeah. And so the tactical side of it, I'll continue that just for a second, because as an example, like you said last year, all three sides or four sides of what you're kind of trying to accomplish got hit really hard in 2022. And so, traditionally, equities got hit hard as well. And so, the fixed income side is supposed to be a buffer, to smooth out those hits. But, last year and I heard from a lot of our partners, there's no safe harbors, this year. But you guys were able to actually, perform relatively well during that with the fixed income side because of the tactical nature of the portfolio, right?
Absolutely. Yeah. And, we've been running similar strategies, as I said, since 1996 that have done well during the dot-com bust, the great financial crisis, 2020. And so we have a very long history of doing this. And what we're doing here is a culmination of that experience.
And so I want to kind of pivot a little bit to, for investors who may not know that are listening to this and kind of think about, what's the purpose of a fixed income model, within my broader portfolio. Can you talk about that and historically, what a 60-40 or 70-30 split might look like and the purpose of that? And so where this strategy might fit within a broader portfolio for an investor?
Sure. So the bond, the 40 part of the 60-40 or the 30 part of the 70-30, has classically underperformed the returns of equities. But we all know that an investment, and especially a long-term investment, has two elements to it. It has the financial element, which obviously you want to maximize that as much as possible. But there's also the human element, the emotional element, which is we can only tolerate so much discomfort as a result of fluctuations in the portfolio. On average, on average per decade, we have 37% declines in the market. And, the obvious mantra there is just, stay the course, stay the course, stay the course. That's great. But in, 2008 and 9, when equities are down 54%, that's a little harder to swallow, right? Especially if you are in a position in your life where maybe you've just bought a new home or you're about to have a child or you've changed jobs and you have less financial security at that moment than at other times in your life. And then your portfolio gets cut in half. Well, the fixed income portion of that is supposed to not correlate with the equities. So while you won't get as much upside in fixed income, you likely won't get hit on the way down in the same way with fixed income. And that worked during the great financial crisis in 2008 and 9. It did not work last year. But even coming out of the great financial crisis in 2009, high yield bonds soared more than anything else more than equities that year. So wanting to have things that are non-correlated so that the emotional ride of the portfolio, it's going to, weave up, is tolerable. And if
Yeah.
your portfolio doesn't drop as far in a down market, it doesn't have as far to climb out after that market is done. So you need actually less return on the upside to achieve the same long-term goal without the severity of the emotional roller coaster.
Exactly. So, and the purpose, it's you call it a balanced portfolio. You're adding that fixed income, portion to balance out the portfolio and to smooth out that ride, as you said. So let's dive into the investment process. So obviously, like you said, you're looking at where we're getting access, and I'll kind of start with this. You're getting access to the bonds and the fixed income side through ETFs. So what's the process look like to decide what ETFs to put in, when to pull them out? And again, like you said, you have the tactical side of the portfolio where you're able to move a little bit more nimbly than a historical fixed income portfolio might actually do. So talk about the investment process and the thesis and the screening process that you guys are using to decide when to get in and when to get out.
Sure. So we're generally trying to recreate indices when we're invested, because selecting individual stocks introduces another level of risk.
Mm-hmm.
So you might be brilliant and have bought Tesla at $10 a share, or you might have bought it right before it dropped by, 60% last year, 70%, whatever the number was. So we want to remove that level of risk from what we're doing. So we are trying to recreate indices, either by buying index products or using instruments that are, we have a small piece of developed international high yield bonds in there, a small piece of emerging markets high yield bonds in there.
Yeah.
But we're not picking individual bonds because there's more risk in doing that.
Mm-hmm.
Then every day we look at a sell signal every day that we're long all of these instruments, and it's based on price movement over time. So if the price of that instrument starts to decline, we're looking to establish a trend. So we're looking every day and saying, okay, that's gone down a little bit. And this is math. This is not, a bunch of people sitting around, scratching their chins about it. But basically, as it moves down, it will trigger a sell discipline, which is a 1 day delay. And then we're selling out over a couple of days because we really want to establish the trend there. We don't want to just pull it all out at once, and maybe we're wrong. Maybe the math is wrong. And it will be sometimes. That's just the way it is. We'd rather have a more nimble trigger to get out quickly than to get caught in a steep downdraft. And the same getting back in. We're looking at price movement over time that will cause us to get back in over a couple of days to then, again, establish the trend on the way back up.
Yeah, so you're really looking at technical indicators. Like you said, you're looking at the actual price chart and going back to what you said earlier, you're not predicting, what's going to happen. You can have your opinions on, okay, the Fed, is looking to potentially, we're pricing in and anticipating, by the end of the year, early next year, that they're going to start, cutting rates. But you can have your opinion one way or the other, but that's not going to affect the portfolio. You're actually reacting to price action, and you have certain indicators that you're looking at to make a determination.
Yeah, every trade we make, I have feelings about, but they don't matter.
Yes, exactly. And we're cutting emotion out. Emotion is not our friend. Yeah. So I'm so excited to have the portfolio on the platform. I guess finally, if you want to just kind of just wrap it up in terms of what makes this portfolio different within trade and the broader market as well. Obviously, it's a more conservative portfolio, kind of going with the fixed income side. But so within EchoTrade, I think it's the only fixed income focused portfolio. And then outside of it, like I said, there's a little bit different between other fixed income portfolios. So if you kind of just wrap it up for us and for the investor on how you see that and the differences, outside and inside the EchoTrade environment.
Yeah. So within and outside of the EchoTrade environment, it's a portion of a portfolio to act as a ballast to attempt to limit some of the volatility that is natural in all equity allocations. So we strive to maximize the return over a long-term cycle and minimize the risk. So that risk of drawdown is what we're trying to limit. But at the same time, we all know that we're not in this to just to park our money somewhere. We want it to work for us. So the idea there that we're going to try and maximize yield over the long term and minimize risk is our absolute focus and what our firm has devoted itself to since the mid 90s when we were founded.
Well, it's awesome. I'm so excited to have the portfolio within the platform. Investors can check out the Toews Tactical Income Bond Model and any more information on EchoTrade. Thanks, Evan. Appreciate the time.
Thanks so much, Jeff. Take care.